So now, next, we're going to talk about why invest into a group. You see the structures. Well, why would you do this at all, right? And I think one of the main reasons why you would do this is that you would be able to purchase more property than you could by yourself. So you can buy more than you could individually. Now, I'm speaking to you guys from two fronts here: people who want to put this together, and then people who want to invest into one, right? Either way, you can buy more property than you could by yourself. A lot of people could start off buying real estate and they love it and it's going well, and then they run out of capital because they're buying money, using their money to buy real estate, and at some point you run out. And a great way to keep the train rolling is to go find great deals and then find investors. All right, so you can buy more than yourself. There's other people who say, hey, I love this idea of buying into a hotel, or I want to, maybe I own some single family houses or small apartments here, but I want to do something bigger. I'm not there yet for me to be able to do that individually. And I don't necessarily have the time or want to manage the project, but I can put my cash with someone who does have the time to manage it and has the experience to do so. So that would be why you would invest into a group. Now, also, you can limit your liability to only the capital that you invest, eliminating mortgage risk and property operational risk. So yes, you can lose your capital in real estate, just like every other investment you invest in. That's a part of investing. That's why you have to take the time to understand risk. So I'm talking about it right now, right? However, losing your money is only one risk in the real estate business. We got something called mortgage risk, right? If you've ever been through a foreclosure or lost a property, you know what I'm talking about, because when the bank forecloses on a property, not only do you lose your money, but your credit can be damaged. And also in California, this is a judicial state. If you're very wealthy and the bank loses money on their loan, which happened a lot in the Great Recession, that bank technically can come after you. They could sue you for the difference. Now, that's a rare occasion, but I saw it happen a few times. You know what I mean? I've seen that happen. So I'm telling you about that. So that's mortgage risk. You can get your credit destroyed if you cross collateral, meaning that this loan is attached to this property and attached to other properties. You can not only lose the property that you lost, but you can lose another property. I saw that happen. I saw a guy build a property downtown Oakland. It was $80 million loan. That property ended up selling for $20 million. They said he lost his whole portfolio. That sucks. All right. So a way that you can eliminate that type of risk is investing into a group, right? Also, not cross collateralizing everything, by the way, not necessarily a good idea. There could be a reason for doing that, but every deal should stand on its own, right? But if you just are saying, hey, I want to put this capital up, but I don't want to have that kind of mortgage risk, that's another great way of doing it. Now, property operational risk is a risk, but most insurance policies are going to handle that. They're going to take care of that. All right. And don't skimp on insurance. I'm not saying you want to pay the premium of the premium, but you don't want to go for the cut rate discount insurance on your investment property, because somebody slips and falls, busts their head, something happens at the property. Look, they're going to come and sue you. If you got the right insurance, though, insurance is going to take care of it. It's not going to be that big of a deal. You can, keep rolling. But a lot of investors, especially people coming over from the stock market or other investments, they don't want no parts of that. They just want to put up the capital and have their capital at risk, right? Because that's what they're used to in other worlds. Investing in a group is a great way to do that, because if you just say, hey, I'm going to go buy this 10-unit building by myself, I'm going to put the down payment, I'm going to get the mortgage, I'm going to run the place, you have all those risks. Not a bad thing, right? Just understand that's a benefit for why you would invest into a group. Now, another thing is, a lot of people say, I want to be no landlord, I don't want to be fixing toilets, and I don't need tenants and taxes and toilets and all of this stuff. So if you put your money into a group, there's a sponsor that's going to handle that, so that you don't have to deal with those issues, right? You're just passively investing. Now, for you sponsors out there, people want to put the deal together, it's kind of the same thing. I don't want to be out there fixing toilets. I'm coming from the office in a suit fixing toilets. I ain't trying to do that, right? You should be having property managers in place. You should be having vendors, contractors, handymen, people that can come out and do the work for you. And if you're running the show, your job is more so as an asset manager than a property manager. Now, if you're a property manager by trade and that's what you do and you have that experience and you can bring that value to the table, which is very valuable, by the way, now you can manage the project, you can have people, and you can also asset manage. But for a lot of us out here, a lot of you guys that are putting this thing together, you will be the asset manager, managing the property manager and managing all of the processes, managing the net operating income, managing the asset. All right. Very important that we point that. That's the leverage that's of having a group and a team to help you out. And the last point I was talking about is you leverage the strengths of other members of the group. So if you have a group, somebody may be a contractor, somebody may have property management experience, somebody may have just tons of dough, somebody may have the most excellent credit in the world, so you can get the best possible interest rate you can, right? You can leverage the strengths and of other members of the group when you're in a group. You can limit your liability, you can minimize the management hassle. So those are some of the great reasons why you would do this. Now, keeping it real, there's also cons. Look, at the end of the day, there's going to be pros and cons to everything, right? I was talking to my son and a couple of his buddies who play ball. I coach football, and my son plays quarterback, and we were talking about, watching the Super Bowl. We were talking about pressure, right? And my son said, "Hey, I love being a quarterback. The only thing about being a quarterback is a lot of pressure when you're at that point." I said, hey, that's a great point. And we're watching the Super Bowl, and I was saying, who do you think got more pressure on them? These two quarterbacks who are in the Super Bowl, or the quarterbacks who are sitting at home watching in the Super Bowl right now at this moment? Who got more pressure? Well, obviously, it's the people who are in the game. They got some pressure on them because they're in that game. And I heard actually this morning something I was listening to on YouTube. It was Tom Ferry interviewing Tim Grover. Tim Grover was the trainer of Michael Jordan and Kobe Bryant. He was he was his personal trainer. What he said was, pressure is a privilege, right? So the higher you go up, there's pressure, right? Which is maybe not the most positive thing to think about. Like when you're a young kid, you want to play ball, you want to get out there looking at the Super Bowl. But those guys, look, in that moment, there's a bunch of pressure right there, but that was a privilege for them to be at that point. And I bring it to this point because there's some cons to group investing. I think the pros weigh out the cons, but nonetheless, the cons exist. And you need to understand that. All right. Understand the first thing is that the investment is illiquid in nature. Right? It ain't liquid. You can't just go and call your stockbroker, hey, I need to sell these stocks. You can't just go on your app here and say, Robinhood, I'm getting ready to sell this Bitcoin. I'm out. You know what I mean? You can call your broker and say, hey, we need to list this property and get it sold. If you own it outright, and even if you do, say you own the property outright and you say, all right, look, we need to sell a property. Y'all know how it goes. Even in the hottest of markets, you have to prepare the listing. You got to sign a bunch of disclosures. You got to get it on the market. In the hottest of markets, a week to 2 weeks, maybe of marketing time. You want to market the property, get multiple offers. Cash offer might be 30 days if it's commercial. Maybe it's 2 weeks if it's residential. They got to do their inspections. They got to do that. So that's what we call illiquid. It's also similar in all real estate. Now, in a group, you can't just call up the sponsor that you put your money with. Hey, I'm running tight on dough. We need to sell this whole building right now. Nah, it don't work like that. When you invest in a group, there's an expectation of how long this is going to occur. Hey, the holding period, right? This typically, it's going to be a little bit more long term. Now, you might be in a flip group and you guys are buying and flipping. But even then, it's illiquid, and you got to wait till the property is prepared to sell, and then it's got to sell, and once it's in escrow, then it's got to close. All right. When you're in a group, it's more complicated because you can't just call that shot. It's a group decision typically when we buy or sell, and there has to be a majority. All right. The sponsor, the leader is going to kind of drive that. So you can't just call and say, I need my money out. It does not work like that. This is a long-term situation, very illiquid in nature, especially when you're in a group. Now, say you do need your money back, if something happened and you actually need that money, you can sell your interest. Say you own 20% of the deal, you can sell that 20% of the deal. However, that's complicated. There's not like a ready market for that. Like if you say you want to go sell your stocks or you want to sell the property outright, you say you want to sell the property outright, there's a ready market for that, right? If you say, hey, I want to sell 20% of a property, there's not a ready market for that. It can be done. Usually when this happens, the sponsors will end up buying that person's interest if they're capitalized to do that, or sell it to another investor in their database. That can be done. They'll do it for a fee, but it ain't like just going and doing it overnight. It's complicated. It's complex. It's going to create some tax situations for you and possibly the group, and it's difficult. Another con is that you may lose complete control of operations, right? So it's both sides of the fence, by the way. So if you're the passive investor saying, hey, I'm putting up some money, you are not the managing member. You are not dictating how the management goes at this property and at this asset. You do have a vote, right? You have a say-so in a limited capacity. That's why I say you lose complete control. You have some say-so, so you're an owner, but you don't got complete control. Flip side for the sponsor, you don't got complete control either, right? And a lot of guys, and I know one of my top clients, my wealthiest client, he does not partner. He does not group invest. He only does his own deals. He won't even take on institutional equity that acts like debt. It's equity, but it's structured as debt. He don't even want that on his deals because he wants absolute control. And when you put together a group, when you syndicate a property, you lose absolute control, even as the sponsor. However, you can maintain management, control over the property asset. And here's the key, syndicators. If you're a leader, meaning that you're a real leader, not just by position, you have influence. Influence can't be taken away. And I guess, yes, it could, depending, but all things considered, you don't lose that. All right. Other investors have voting rights. They may have ideas on when they want to sell, when they want to refinance, all of this stuff, but you can maintain the leadership, the captain of the ship, so to speak, by being a great leader and having an influence over people in a positive way. But understand, you don't got full control over the deal. Not no more. Not when you go into a group. All right. Decisions on when to buy, sell, or refinance are group decisions, and dealing with partners can be difficult. All right. Just like dealing with people in business in general can be difficult. So I want to break these down, but I don't want to make it seem like the end of the world, because it ain't. Right. These are just some things like to understand and consider. It's like what the guy Tim Grover said, pressure is a privilege. And these are some of maybe the pressures that come along with the glamour of syndicating properties. Now, you be the judge. I think pros outweigh the cons by far and away, but I'm always going to break it down to you guys and keep it real from both sides of the fence.